Okay, Chapter 5, we're going to be looking at gross income and exclusions. Specifically, we're going to be talking about the realization of income and explain when taxpayers recognize gross income. We understand the distinction between the various sources of income, including what income from services is and income from property. And then we're going to apply some basic income exclusion provisions to compute gross income. So let's get right into it. Gross income. Realization and recognition of it. So taxpayers report realized and recognized income on their tax return for the year. Now, some income is excluded or deferred and is not included in gross income. We've talked about that. Excluded income, remember, is never taxed. Deferred income is only taxed in a subsequent year. So what is gross income according to the law? Well, there's Code Section 61A of the Internal Revenue Code. And it starts with except as provided. So you have an exception already. Except as provided. Gross income means all income from whatever source derived. So that's basically saying unless you could find somewhere where the code section said it's not included, it's included. So it's excluded by exception, by law. Regulation 1.61 further explains and justifies the definition of this includes income realized in any form, whether in money, property, or services. So what they're saying here is you can't say, oh, that person paid me with their car. I don't have to include anything in income. I only have to include it if it's cash. That's not true. So if you receive property in a taxable transaction, you recognize the value of that on your tax return as income. Or even services. For example, if you're in business and say you do tax returns, that's your business, and you know someone who cleans furnaces, and you say to them, clean my furnace and I'll do your tax return in a barter transaction. You value those services and include the value of those services on your tax return. You don't say, no income, it was barter. No, that's not how that works. Even in trade, you value the services, value the property, or then you have the actual money. So taxpayers will recognize income when they receive an economic benefit. And this is on page, let me grab the page. 5-3 of your book. So it could be receive compensation from working, you receive proceeds from selling a product or selling an investment. Also, people will say, well, what happens when I get a loan? Because I received an economic benefit if I get cash or I bought something with a loan. And the answer there is no. You do not have, that's not considered part of this because you have to pay it back. So if you didn't have to pay it back, that would be different. But because you have to pay that loan back, it's not looked at as being a recognized income item. They realize the income. So when you receive an economic benefit, that income, you realize it, and then the tax law will let you know if you can exclude it, like I was just talking about, or deferring it. And there's your economic benefit. The realization principle is when they're saying basically you've got something. It actually happened. So the taxpayer engages in a transaction with another party and there's a measurable change in property rights because of it. So things like you received money, you received property, you got a dividend, you've got interest income, you received money for services. So there's something that actually happened that changed your property rights. It's a measurable change. Generally, then realized income is also assumed then to be recognized, unless it's excluded or deferred somewhere else in the tax law. Again, remember what I said, the form of receipt does not matter. It doesn't matter if it's cash, property, or services. The other item, there's an important principle called the return of capital principle. So, not all income you receive in a property or in a transaction may be taxable. And here's what we're talking about. Let's say you're selling an asset that you purchased. The cost of that asset is called its tax basis. When you sell, the part of the selling price that can be allocated to the cost basis is not taxed. So when you're computing the amount of income to realize when selling it, you subtract the cost basis. It's because that part of the selling price or the realized income is just a return of your investment or a return of capital, what you originally paid for it. So that part isn't taxed. It's the part above the cost, the gain, that would be taxed. Another concept, recovery amounts previously deducted. Individuals typically claim deductions in the year they pay them, and they're allowed to. So on a tax return, on your federal tax return, if you deduct something in 1 year and get a tax benefit from it, your taxable income decreases. And in the next year, that deduction is reimbursed to you from wherever it originated, you have now what's called a tax benefit. You took a deduction for something and you got the money back. It's like you didn't even pay the money. When that occurs, in the year you get the refund, you include that amount as income on your tax return. Here's an example. Last year, Courtney reported $9,500 in itemized deductions. Remember your tax formula? Gross income less deductions for adjusted gross income equals adjusted gross income. Then we could subtract the greater of itemized deductions or standard deduction. Well, in this case, she deducted the greater amount, $9,500 in itemized deductions. One of those items that are included in that $9,500 was $3,500 of state income taxes she paid during last year. Okay, so last year her employer, let's say, withheld out of her paycheck $3,500 in state income taxes. That's an allowable itemized deduction. In March of this year, when Courtney did her state income tax return, it ended up that she paid in too much during last year and she received a $420 refund of the $3,500 in the state income taxes she paid. So she deducted all $3,500 like she wasn't going to get a refund on her federal tax return, when in reality she got some of that money back. So she shouldn't have deducted all $3,500. She should have deducted $3,080 because that was her actual tax liability. Well, the IRS doesn't say, well, go back and redo your tax return from last year and only deduct $3,080. No. They say, no, you got a benefit. Last year, you deducted that $420 that you got a refund for. So this year, included in your gross income. And actually, if you have a 1040 available, that $420 goes on line 10, I believe, of your 1040. So this is a common thing that happens. Oops, I'm sorry. I was a little wrong there. I forgot about the standard deduction amount. Don't worry about this part of it. It's a little too, we'll get into this more. But just so you could see this. Here's what they're saying here. Her standard deduction amount, so what she would have deducted is $9,300. She got to deduct $9,500. So really, of that $420 refund, it was only a $200 difference because No matter what, you would have deducted 9,300 because of the state income taxes. Let's per se, she got to deduct 9,500, so she only got to deduct an additional $200. So only 200 of the refund would be included in her income. Normally, that's not the case. And if you have any questions on that, please let me know. Post them out on the discussion board. When to recognize income? They generally include it on the individuals included on their tax return for the calendar year. Corporations, I'm not worried about them, but they often have a fiscal year end. The method of accounting generally determines when income is realized and recognized and included in gross income. So let's take a look. Corporations generally use the accrual method of accounting like we do in financial accounting. Not worried about that. We're worried about individuals. Individuals use cash accounting, meaning you include income on your tax return the year you receive the money, or we're going to talk more about that. Generally receive it or constructively receive it, and you deduct when you generally pay it, the year you pay the item. Constructive receipt. So we said generally when you receive the income. Well, if you start thinking about it, people could start playing with that, right? They could say, oh, if somebody owes them money, or like say a customer, somebody buys something off of a business and a customer is going to pay the business. The owner could say, I don't want that income on my tax return this year. Let's pretend it was bought next year. Don't give me the cash till next year. And then they could say, well, I didn't get the cash. I didn't get the cash till the next year. Well, these loopholes were found, and they came up with this other rule that says, well, you either receive it or you constructively receive it. Taxpayers must realize and recognize income when it is actually received or constructively received. Constructively received means this. You had access to the money, so the transaction occurred, and you had the ability to get the money, and there were no restrictions on the money. You just chose not to take it. Okay, so if those two items are part, if they're not available. Sorry, it's 5 o'clock in the morning. If they are present, that's the word. So if those two items are present, you're considered to have received the cash and included in income. Give you an example. You have a customer. It's December 31st. They pay you with a check. You don't deposit it until the next year. There is plenty of money in your customer's checking account to cover the check. When is that income? It's income when you constructively receive it. You received it December 31st. They had plenty of money in their checking account to cover that check. You chose to wait till the next year to deposit it. You should have put it into your checking account on December 31st. Even though it's a check, it's still considered constructively received if the money is available in the customer's checking account. Same situation. If you had gone to the bank and cashed that customer's check, it would have bounced on December 31st because there wasn't enough money in the customer's account. This is a different situation. Now you have a restriction. The money was not available to you. So when you go and deposit it in January, when there is enough money, now it's income in January. So these things can get very hairy and tricky. So you got to look, was the money available and was there any restrictions on it? Claim of right. Income is recognized when there are no restrictions on use of the income. So if you have no obligation to repay, in other words, then you recognize the income when you receive it. So that's why loans generally are not included in income. In addition to determining when taxpayers realize and recognize, it is important to consider who recognizes the income. So this question arises when an income shifting strategy is involved. And people try doing this, and there's actually a very famous case called Lucas versus Earl, and it's called the assignment of income. And I believe what it was, if I'm remembering the court case correctly, um, I think it was Lucas. He was working at a job and he didn't want the income in his name. So he told his employer to put it in his wife's name. Give her his paychecks so it looks like it's her income. And this court case went all the way to the Supreme Court, as I said. And they get these great analogies, but it's called the fruit and the tree analogy. And it's a very famous analogy in taxes. And it basically says this: you cannot pull the fruit off of one tree and say it's from another tree. So the tree would be Earl. The fruit is the income from him providing services. So if you're providing the services, if you own the property, you can't say any income from that is somebody else's. You must recognize that income on your own tax return. You can't separate the two. So there is no, you cannot assign the income. It will come back to the owner, the person who performed the services, etc. Now, it's not saying, I mean, you can have your employer there if they do put it in your wife's name. Go ahead. But here's how the courts look at it. You received the income and then you gifted it to your wife, even though the check is made out to her directly. That's how the courts would look at it. The other assignment is community property, and you could read through that. We do not have community property system in Pennsylvania, and I've actually never dealt with it in my career, but it is an income shifting um, item when people are married with how they recognize income on their tax return. There's the assignment of income again. So taxpayers who earn income from services must recognize the income on their own tax return. If you have property and you receive dividends and interest on that property, it's taxable to the person who actually owns the property. To shift income from property to another person, a taxpayer must also transfer the ownership of the property to the other person. Here's your community property. 9 states, half of the income earned from services of one spouse is included in the gross income of the other spouse. Half of the income from property held as community property, so they own it jointly, is included in the gross income of each spouse. And then property that a spouse brings into a marriage is treated as that spouse's separate property. So if you're involved in a state like that, you'll have this, but I can tell you in Pennsylvania, you won't. We are a common law. So the it's basically whoever earns it, that's who puts it, that's your income. It doesn't matter if you're married or not. Now, the types of income. Income from services. So if you're physically doing something or mentally doing something to earn your income, you are considered earned income. So we're looking at wages from a job. If you're a sole proprietor, the profits, or a partner in a partnership, or a single member LLC. These are all earned income items. Unearned income are more from investment properties, things like your savings account, your stocks, your bonds, sales of investment items, land, jewelry, guns, things like that. Okay, so we've looked at realized recognized income, that some of it may be excluded, and who recognizes it, when they recognize it, and the different accounting methods. Oh, and the type of income. Now let's start looking at where we can exclude income that a person may receive. And the first major area is called annuities. Now, an annuity, all that is, I hear the word annuity all the time. It's describing an investment where you will get a stream of the same dollar amount of payment for the same time period. So $100 monthly for a certain time, $300 every 3 months for a certain period of time. So that's all the word is used to describe. A lot of people look at an annuity as an investment because that's commonly where this occurs. Now, You might want to grab a piece of paper. We're also going to have a example. You need to look at this as the following. Remember that return of capital concept. Okay. When you have an annuity, the person who is receiving these equal payments over an equal period of time must invest, purchase this ability to do that. So they pay in an investment amount. Let's say it's $100,000. So they give, and usually it's like an insurance company or a bank, $100,000 for the right for these equal payments over an equal time period. So when they're receiving, the person receiving these equal payments over equal times, some of it is the money they originally put in to have this right. So it's a return of capital. Now remember what we talked about with return of capital. That part of the payment is not taxed. That part of the payment is you just getting your money back. Now, normally when it's a one-time deal, like a sale, we say what did you sell it for? Minus what's the cost? Blah, there's your gain. But in this case, you're not receiving all the money up front. You're receiving it over time. The IRS doesn't say, well, the first $100,000 of your annuity payments will be tax-free. Nope. They come up with a ratio, and they will exclude a portion of the annuity payments received each year from income. And they call that part of your payment each year a return of capital. And here's how they determine it. They take that investment amount and they divide it by the total amount you'll receive on that annuity. They call that the expected return. So it's the total amount of the payments that will be received. So let's say you're getting $1,000 a month for 10 years. That's what the annuity promises to pay. So you invest $100,000 today into this annuity for the right to receive $1,000 a month for 10 years. Well, that's $12,000 a year, right? Times 10 years. So you're going to receive a total of $120,000. You're going to create a fraction. And that's what the bottom formula. We need to figure out how much of the payments each year are excluded. They're considered a return of capital. And we do this by this ratio. We take our original investment of $100,000 and we divide it by that $120,000 we expect to receive. So that portion, or 83%, is considered 83% of our $12,000 each year is considered a return of capital. So that portion is not taxed. So 17%, the other 17% is included. So if you take 12,000 times 17%, that will be the amount that is included in income each year. So a portion is excluded, a portion is included. Here's another example. Graham purchased an annuity for $99,000. There's the investment. Pays her $10,000 a year for the next 15 years. So her total amount will be $150,000. How much of each $10,000 payment should Graham include in her income? Well, 66% is excluded. So 34% would be included, the other 34%. The 100% number being 10,000, 66% or 6,600 would be excluded. So 3,400 would be included. Now, that is a really straightforward example because we know how long you're going to receive the payments. But what happens if it says the annuities are going to be over a life? For example, what if Graham up there purchased an annuity, $10,000 a year for the rest of her life? Because sometimes that's how annuities are written. Now you don't have a definitive time period. Well, the IRS has used tables to determine the life expectancy of the taxpayer when they start receiving the annuity. And based on that life expectancy, we'll come up with the expected return, or how much that amount will be they'll receive over their life, to determine the exclusion and inclusion ratio. Take a look. I want to look at a quick example with you. On page 5-12. Okay, and there is the table. So what we're saying in that, before I get into property dispositions, what we're saying in that bottom bullet point is this. You're still going to take the original investment in your numerator. But when you're calculating the expected return, how much Graham, let's say, is going to receive over her whole life, we have to say, how old is Graham when she starts receiving her $10,000 a year? So let's say she's 70 years old. Well, the expected return is 16 years. So we would take that 10,000 times 16 to determine how much of each payment is excluded and how much would be included on her tax return each year, because it's not defined in the contract itself. Property dispositions. We've talked about this already. Taxpayers usually realize a gain or loss when disposing of an asset. Taxpayers are allowed to recover their investment in property before they realize any gain, and that's generally because it happens all at once. So we take the sale proceeds, so what we received, minus any selling expenses you might have had. You had to pay a commission to the stockbroker to sell your stock. That's an example. And that's what we call the amount realized. Amount realized. We then subtract the tax basis, and that's normally the investment. Now, we may add or subtract to those things, but for now, that's how you have to look at that. And if it's a positive amount, you made a gain. You sold it for a profit. If it's a negative amount, you sold it at a loss. So you sold it for less than what you were originally invested in it. So we must calculate those gains and losses depending on the type of property. We would then put it on the tax return, and we have chapters on all of that. So we just want to get a general feel for how we calculate the gain or loss. Other sources of gross income other than wages or business and property. Income from flow-through entities. So an individual may invest in various business entities. For instance, they could be a partner in a partnership. They could be a shareholder in an S corporation. Okay. In the legal form of the business affects how the income it generated by the business is taxed. A partnership and an S corporation are special entities. They report the entity itself, the partnership and the S corporation, create their own tax return. For a partnership, it's a 1065. You could look it up on the IRS's website. And for an S corporation, it's an 1120S. And all these tax returns are showing the IRS is detailed information about how the business operated. It's showing them the revenue and expenses and what the overall profit or loss was in the business. There's no taxing being done to the partnership or the S corporation. So those entities do not pay income tax. What they do is report the income or loss to the partners and shareholders. They use a special form. It's called a K1. So if you're a shareholder in an S corp and you own 10% of the S corp, 10% of the profit or loss will be reported to you on a K1. Same with the partnership. And then you put the profit or loss from the partnership or S corporation on your individual tax return, and the shareholder, you, pays income tax on it. And this would go, it ultimately ends up on line 17 of the 1040. So you can see there, it says rental real estate, royalties, partnership, S corporations. So we call these flow through entities because the entity itself does not pay the taxes. The shareholder or the partner, the owner, pays the taxes on the profits or deducts the loss on their personal tax return. Now, if you say, well, that's not fair because what happens when they take money out? Well, just as long as they're only taking out the amount of money that they've been taxed on, the profits, it's tax free to the owner. Alimony. For tax purposes, this is important. Anybody could call anything alimony, but for tax purposes, here's what alimony is. It's a transfer of cash, cash only. No property, so the house, the car, the investments, not nada. It must be in cash. And it's made under a written separation agreement or divorce decree that's recognized by the courts. In the separation or divorce decree, it does not designate the payment as a non-alimony payment. So it cannot say it's not alimony. It doesn't have to say it's alimony, but it cannot say it's not alimony. In the case of this legal separation or divorce taxpayers, the spouses cannot live together when the payment is made. That happens sometimes. Don't ask me. I don't understand it, but it does. The payments cannot continue after the death of the person receiving the alimony. So, what does not qualify as alimony? Property settlements. So, when you're dividing up your property, that is not alimony and it's not even taxed. Child support payments fixed by the divorce. So, sometimes in a divorce or separation agreement, it'll say, this spouse, one spouse, will pay the other spouse $1,000 per month. It doesn't say it's not alimony. It doesn't really call it anything. But here's what the qualification is on it. When child reaches 18, the payment will go down to $700 per month. So how much is really the alimony portion of that payment? Well, obviously, if it goes from $1,000 down to $700 when the child reaches 18, $300 of that payment is child support. And child support is not considered alimony. It's not taxed to the recipient or deductible by the payer. So the true amount of alimony each month is $700. So you have to be careful of that. Excluded are prizes and awards. I'm sorry, prizes and awards. Prizes and awards are included in income. So you go on Jeopardy, you win 100,000, that goes on your tax return. You go on Biggest Loser, you lose all this weight, they give you all these cash prizes, a trip to Aruba. That's all income. Prizes, awards, they go on your tax return. What isn't though? You can only exclude a prize and award if you get it for a scientific, literary, or charitable achievement. And it's transferred to a qualified charity immediately. You never get it. You just say, I want it, that's great. Transfer it to this charity. So that's the first thing. So if it's a check made out to you and then you give it to the charity, that doesn't count. You have to direct it right to them. Also, you can't have done something. You can't have actively been looking to win this prize. It's just something that, like it's like the Nobel Prize. They just give it to you because you're fabulous. Okay. So you immediately transfer it to the United Way, non-taxable. Everything else you would include it in income and then deduct it as charitable deduction if you could. The next bullet point, and this is important for employees. Most employee payments of any kind are considered income, even if your employer calls it a gift. In taxes, they look at it as income, except if the prize or award is for an employee length of service or safety achievement, and it's a property item. $400 is the limit for non-cash property. So, and here's the other thing, so you know, and I don't think your book mentions it. It doesn't. Let me just double check something. They mention it in your little footnote, so you want to take a look at it on page 517, footnote 24. They don't put it in the reading, they put it in the footnote. This is important. It's $400 if it's what we call a non-qualified plan. So if your employer just comes up to you and says, "You're doing a fabulous job. Here's a watch." You know, you're doing a fabulous, or I'm sorry, you're doing a fabulous job and you haven't gotten hurt. You're like the only employee around who doesn't get hurt. This is for your safety achievement, and it's a $300 watch. You're cool. It's under $400. If they come up to you in the same scenario and give you an iPhone that costs $1,000, now you have to say, uh-oh, 400 is excluded of that value. The other 600 is income to you. Unless the safety or length of service is available to everyone. So if there's a policy that says if you achieve these items, anybody, you will receive an iPhone. Or if you're here for 10 years, anyone will get an iPhone. Now the value is $1,600. So if that award you receive is less than $1,600 and it's offered to everyone, the same award, then it's non-taxable. To Team USA athletes from U.S. Olympic Committee on account of their competition in Olympic and Paralympic Games. Now that's something new. Okay, so this is another award that is limited to what it's actually being taxed at. Now, if it does not, and if you look on page 5-17, right above where it says taxes in the real world, it says while there is no limit on the exclusion amount, the exclusion does not apply to a taxpayer. So somebody in this situation, if their AGI exceeds $1 million before the reward. Okay, so a lot of these people are making that kind of cash flow. But if they're not, they don't have to include the award in that situation. The next major item that is excluded from income is Social Security benefits. These benefits are taxed, they may be taxed up to 85%, but that's it. So if you have a taxpayer, a client, who is receiving Social Security benefits, never will, well, at this point, the law does not allow for 100% of those benefits to be included in income. Only up to 85% maybe. And there's a special calculation we do to determine the amount of taxable benefits. We first start with what's called modified adjusted gross income. And here's what we do. We take a person's AGI, their AGI. So there you go. There's that AGI. That's very important. Gross income minus deductions for adjusted gross income gives us AGI. You don't include any kind of Social Security, so you have to figure out adjusted gross income before anything with Social Security. We then add to that amount what's called the tax-exempt interest income. So it's not taxed, it's still not taxed, but for determining how much of Social Security is included in income, we add that to our AGI. And then we add in what's called excluded foreign income. So if we have any foreign income that is excluded from gross income, we add that in. And those are the two major items. So once we get that amount, we then compare it. We then compare it to base amounts. Now, these base amounts are, of course, they're not presented there. For a single taxpayer, if that computation that we just did, AGI plus foreign income plus interest income plus 50% of your Social Security benefits, if that amount is less than or equal to 25,000, none of the Social Security benefits are taxed. None of them. If you're single and the amount you computed is greater than 25,000 but less than or equal to 34,000, here's your computation. Some of your Social Security will be taxable, and here's how you compute it. It's the lesser of A. So first, 50% of your Social Security benefits. Or B, 50% of that modified adjusted gross income. So that's adjusted gross income plus tax exempt interest plus foreign income exclusion. So we take that plus 50% of our Social Security benefits. Okay. And subtract it from 25,000. After doing that computation, take 50% of it. The lesser of those two amounts Joint taxpayers have a different um, level, and that is on page 5-18. Theirs is 32,000 instead of 25, and for the first level, and then 44,000 for the second level. Okay, more items that are included in income. Imputed income. Certain employee discounts or low interest loans generate income via indirect benefits. So if you are given a low interest loan, the amount of it, or you get provide, I'm sorry, if you provide a low interest loan, the amount of imputed income is the difference between the amount of interest using federal interest rates and the amount of interest the taxpayer actually pays. So what they're saying here is that you should take and determine how much you should be charging the person you loan the money to, and see how much interest you should be showing on your tax return, and compare that to what you actually are receiving and the difference you have to show as income on your tax return. The borrower is deemed to pay imputed interest. So it's like you actually did pay, you did receive it. And then the lender is deemed to have returned the imputed interest to the borrower. That's the way the IRS looks at it. Imputed interest rules do not apply to aggregate loans of $10,000 or less between the lender and borrower. So you loan your daughter $8,000. I mean, most relationships like that, they're not even, they're looking at it as a gift. So, isn't that nice? The next part is discharge of indebtedness. And this is when a taxpayer's debt is forgiven by a lender. So this is one situation that when you take a loan in the future, if the lender says, don't worry about paying that back, that part of the loan will be included on your tax return. There are some exceptions. If a taxpayer, though, is insolvent, so their liabilities exceed their assets, a discharge of indebtedness then is not taxable. If the discharge of indebtedness makes the taxpayer solvent, the taxpayer recognizes taxable income to the extent of his solvency. So what they're saying here is that if you're in a situation where you just cannot pay your bills, and they're trying to make you equal so that you don't have to file bankruptcy, they're not going to make you pay tax on that. But if you are in a situation that it's your assets, you have the money to pay it, and they're still forgiving a part of your loan, you're going to put that on your tax return and pay income on it.